What if the greatest financial disasters in history were not accidents, but patterns we keep repeating? From the roaring 1920s to the global crash of 2008, and now, in today's fragile economy, the story might sound eerily familiar. Between 1929 and 1933, the quantity of goods and services produced in the United States fell by 1/3. The unemployment rate soared to 25% of the labor force. The stock market lost 80% of its value and some 7,000 banks failed. But before things came crashing down, there was the Roaring Twenties. The Roaring Twenties is a term for the 1920s, especially within the United States and other Western countries where the decade was characterized by economic prosperity, rapid social and cultural change, and a mood of exuberant optimism. By the dawn of the 1920s, the Second Industrial Revolution had transformed the United States into a global economic power and drawn millions of Americans to cities. With a concurrent rise in immigration, the 1920 U.S. Census was the first in which majority of the population lived in urban areas. One reason for the acceleration of the economy was the expansion of electricity throughout the country. The portion of U.S. households with electricity rose from 12% in 1916 to 63% in 1927, and its widening use in factories led to increased productivity. Also contributing to the economic boom was the advent of mass production methods such as the assembly line, which spurred the growth of the automobile industry. The technological and manufacturing boom ushered in a modern consumer culture. With electricity came a range of new household appliances, such as the refrigerator, vacuum cleaner, and washing machine, and the increased availability of credit made it possible for many Americans to afford them. The growth of the advertising industry and the development of sophisticated marketing techniques also helped create demand for these and other products in an expanding mass media landscape. The 1920s also brought about social changes for women in the United States. Women had entered the workforce in significant numbers during World War I, filling jobs that had been vacated by men sent to war and taking new jobs that aided the war effort. Their contributions galvanized support for the suffrage movement, which culminated in the ratification of the 19th Amendment in 1920. Many women remained in the workforce after the war, especially as growing industrialization provided greater opportunities. During this time, the stock market in the United States underwent rapid expansion. The prices of stocks soared to fantastic heights, and the public, from banking and industrial magnates to chauffeurs and cooks, rushed to brokers to invest their liquid assets or their savings in securities, which they could sell at a profit. Billions of dollars were drawn from the banks into Wall Street for brokers' loans to carry margin accounts. The spectacles of the South Sea Bubble and the Mississippi Bubble had returned. People sold their Liberty bonds and mortgaged their homes to pour their cash into the stock market. On Tuesday, October 24, 1929, the stock market crashed. This catastrophic decline in the stock market of the United States immediately preceded the worldwide Great Depression. That stock market crashed is still considered the worst one in modern history. Share prices, which have been trending upwards for almost a decade, dropped 4.6% on Wednesday, October 1923. Nearly 12.9 million shares were traded the next day, exceeding the previous number of trades in a single day by almost 4 million. Stockbrokers with telephone and ticker tape could not keep up with the extraordinary volume of trade requests from shareholders, resulting in delayed and incorrect reports, which exacerbated widespread panic and confusion. Police were dispatched to the New York Stock Exchange to quell potential rioting, while Wall Street executives tried to reassure the public. As the events of Black Thursday unfolded, several major banks and investment companies bought up great blocks of stocks in a briefly successful effort to stem the panic of investors. At the end of the day, the market closed only a few percentage points down, and on Friday it recovered very slightly. Wall Street calculated show of confidence ultimately failed, however, as nervous investors resumed selling stocks the following Monday and Tuesday, later known as Black Monday and Tuesday, when prices declined by a further 12.8% and 12% respectively. As stocks declined in value, brokers and investment companies for stocks sold on a margin required more money from buyers to compensate for the loss of collateral, and buyers themselves raced to sell stocks to minimize their losses. Black Tuesday is generally considered the last day of the stock market crash of 1929. This time, the bubble wasn't stocks, it was housing. Banks handed out risky mortgages, investors piled in, and Wall Street believed the system was unbreakable. But just like in 1929, confidence turned into collapse. Subprime mortgage crisis, credit crisis, credit default swaps, TARP, too big to fail. Phrases like these were ubiquitous in the fall of 2008. The period ranks among the most devastating in U.S. financial market history, and those who lived through it will never forget the turmoil. The collapse, which triggered the worst economic downturn since the Great Depression, wasn't the result of a single event but years of risky financial practices. While many Americans recall watching in horror as the Dow Jones Industrial Average plummeted nearly 780 points in a single day in October of that year, then its biggest one-day drop in history, the seeds of a crisis that would cost the global economy more than $2 trillion of economic growth were planted years earlier. The 2008 financial crisis resulted from a convergence of multiple factors, including a housing bubble, risky mortgage lending, complex financial products, and inadequate regulation. Not just subprime mortgages alone. The Wall Street's creation of mortgage-backed securities, MBS, and credit default swaps, CDS, spread housing market risks throughout the global financial system, magnifying the impact when the bubble burst. The crisis led to the largest financial reforms since the Great Depression, including the Dodd-Frank Act and the creation of the Consumer Financial Protection Bureau to prevent predatory lending. Between 2007 and 2009, U.S. households lost over $16 trillion in net worth, the value of the stock market fell by half, and unemployment reached 10% as the crisis turned into the Great Recession. But while today's financial system has more safeguards against such a crisis, growing complexity in financial markets, the rise of derivatives based on cryptocurrencies, and shadow banking could create new risks that require vigilance. This crisis saw many major financial institutions face failure, require government intervention, or be absorbed by stronger entities. Notably, when Lehman Brothers filed for bankruptcy, it set off the worst financial crisis since the Great Depression. And now, in the 2020s, we face familiar warning signs: rising inflation, record levels of debt, speculation in cryptocurrencies, meme stocks, and tech giants valued in the trillions. Central banks struggle to keep economies stable, while the gap between rich and poor widens. The question is, are we setting ourselves up for another fall? We are seeing escalating trade tensions and high interest rates, which leads to stagnant growth, low industrial output, and increasing unemployment. Also, falling gross domestic product, GDP, signify an economic contraction and a volatile stock market, reflected by the VIX volatility index. A contracting global trade, a rise in SME worries, and the possibility of a SOM recession indicator are also warning signs of a potential economic downturn. Whether it's 1929, 2008, or today, the pattern is strikingly similar. Rapid growth, easy money, reckless speculation, and then collapse. The technology may change, but human behavior rarely does. Greed, fear, and the belief that this time is different keep fueling the cycle. History doesn't repeat itself, but it often rhymes. The Great Depression reshaped the world. The 2008 crisis reshaped a generation. And today we stand at another crossroads. The question is, will we break the cycle, or are we destined to relive it all over again?